you're going to spend a lot of time on investment, I just advise looking at as many things as possible, and you will find some bargains. And when you find them, you have to act. It hasn't changed at all since I was here in 1951, and it won't change the rest of my life. So you start turning pages. When I got out of school, I turned every page in Moody's, 10,000 some pages twice, looking for companies. And you have to find them yourself. The world isn't going to tell you about great deals. You have to find them yourself, and that takes a fair amount of time. One thing I will tell you is that the worst investment you can have is cash. Cash is going to become worth less over time, but good businesses are going to become worth more over time, and you don't want to pay too much for them, so you have to have some discipline about what you pay. But the thing to do is find a good business and stick with it. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it. But I don't look based on countries or that sort of thing. I just read every report I can, and I try and figure out whether something is cheap. The guys read Playboy. I read annual reports. And that's what I do. I mean, that's my job, is to allocate capital. And the way I allocate capital is by looking at the opportunities for using capital.
Well, I look at a lot of figures just in connection with our businesses. So I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses. What those numbers tell me, they're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year, and we care a lot about the price. We do not care about the next 12 months. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right.
Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. It's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. If you buy Coca-Cola today, you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get? When are you going to get it? And how sure are you? When I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? If you can't answer that question, you can't buy the stock. A lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those.
We haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. I don't think we've ever made a decision we should buy or sell based on what the market is going to do, or for that matter, on what the economy is going to do. We don't know. We haven't ever timed anything. We've never figured out insights into the economy. We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money.
Defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, I'm no genius, he said, but I'm smart in spots, and I stay around those spots. And, that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should.
In businesses, we're looking for an entity that has durable competitive advantage, somebody that not only is doing well now, but will do well 10 or 20 years from now. And in capitalism, when you have a wonderful business, it's like having an economic castle. And the nature of capitalism is that people want to come in and take your castle. It's perfectly understandable. I mean, if I'm selling television sets or something, there's going to be 10 other people that are going to try and sell a better television set. If I have a restaurant here in Omaha, people are going to try and copy my menu and give more parking and take my chef and so on. So capitalism's all about somebody coming and trying to take the castle. Now, what you need is a castle that has some durable competitive advantage, some castle that has a moat around it. And that moat, one of the best moats in many respects, is to be a low-cost producer. But sometimes the moat is just having more talent. I mean, if you're the heavyweight champion of the world and you keep knocking out people, you've got a competitive advantage as long as you can keep doing it. And it's very profitable if you're the one that happens to be able to do it. If you can turn out great motion pictures, I mean, Steven Spielberg, I mean, he's a fellow to bet on, and it has enormous economic value. Well, we're looking for that institutionalized. We're not looking for the best brain surgeon in town. We're looking for the Mayo Clinic. So we want an institution that, regardless of the person in charge, will maintain that competitive advantage over the decades. And we hope we find that in some businesses, and then we try to get the best person that we can to run them. Usually it's the person who's been running them.
The earlier part about, I've said about learning from your mistakes, the best thing to do is learn from other guys' mistakes. I mean, it's like, Patton used to say, it's an honor to die for your country, but make sure the other guy gets the honor, so our approach is really to try and learn vicariously, but there's a lot of mistakes that I've repeated. I can tell you that. The biggest one, probably the biggest category over time, is being reluctant to pay up a little for a business I knew was really outstanding, or to continue to buy it at higher prices when I knew it was outstanding. So the costs of that have been in many, many billions, and I'll probably keep making that mistake. The mistakes are made when there are businesses you can understand and they're attractive and you don't do something about it. I don't worry at all about the mistakes that come about because when I met Bill Gates, I didn't buy Microsoft or something. That's not my game. But the mistakes are made most of our mistakes have been mistakes of omission rather than commission.